I am joined by Milton Berg of MB Advisors. Milton is a technical analyst with a unique approach to studying the markets. He focuses on turning points. And as you will see by the end of the interview, I think his process is unlike any other. Milton, great to have you here. How are you?
Jack, how you doing? Haven't spoken to you in a while. Good to see you.
Good to see you too. Milton, tell us a little bit about your framework. How do you go about analyzing market? It is technical, so rather than fundamental. But what do you look for, and how do you identify a turning point? What is a turning point?
Okay, well, the technical analysis we use is not the kind of technical analysis that most technicians use. We don't generally look at moving averages and moving average crossings, and we try. If you want to have an edge in the market, you really have to try to discover things that most people aren't looking at. Of course, there'll be some overlap, and I'd say most technicians and even fundamentalists actually are trend followers. They get in the markets when they feel the market's been doing well, and they get out when they feel the market's been doing poorly. And we're not trend followers. We try to catch turning points. Turning points is if the market is making a top, we like to get out or get short within days of the top. And if the market is making a low, we like to get in and get long within days of the low. So the indicators we've developed are those that are able to pinpoint market lows. Now, some of these indicators are very non-conventional because besides using market data, we also use data that has proven to work. For example, we use what we call cyclic data, lunar data, and these fortunately for this kind of data goes back to history of the world and certainly to history of stock markets. So we're able to study phenomena that have effect to the markets. I know it sounds strange to talk about lunar data, but when people talk about seasonality, they really talk about solar data. When they talk about a January effect, well, that's just solar data. January comes after as the winter begins. But the reason I say this is because we got long China on the exact day of the low. We took a 25% position in MCHI, which is an ETF, and that bottomed on intraday. It bottomed on October 24th, and that was one of our cycle dates. And they had declined 12% into that low. And I saw many other analysts say, oh, wow, momentum's against you, don't invest China. And besides the fact that it was way oversold and the fact that sentiment was way on the bearish side, we also had one of our cycle days exactly on that day. We actually had a double cycle day, something called the spiral calendar or autumn panic day. And we're 25% long MCHI, which is up 50%, more than 50% since then. That's just one sort of an example. We're very, very bullish on China. Mm-hmm. China has a government. There's not much political discussion in that government. It's basically a dictatorship. And they've made it clear that they like to see the markets move up. They made it clear they like to reduce bankruptcies. They like to see the real estate stop declining. It's been declining for over a year now, month after month. So when you have a dictatorship on the side of a market, after the market has declined 61%, it's kind of a good reason to buy. And on top of that, we had our cyclic and technical indicators suggesting a buy. Of course, there are many gaps off that low. So there are many, many conventional types of indicators suggesting that's low. But that's the reason I mentioned MCHI, because we look for turning points, and we got in exactly on the day of the turning point, exactly on the day of the low. And I know many conventional analysts says you can't buy now because momentum is against you. Now, we don't use momentum necessarily after a long move. We use short-term concentrated momentum at the beginning of a move. So, for example, historically, the S&P 500 has gained 7.4% at a minimum within the first month or two of a major market low. That's a momentum indicator. We try to pinpoint it because usually it takes place within the first 10 days of a low. Unfortunately, this latest low in the market did not see this type of momentum off the low. You saw it off the lows in 1970. You saw it off the lows in 1974. You saw this type of momentum right off the lows in 1982, again in 1984, again in 1987. You saw it off the lows in 2002 and 2003, and you saw it in 2008. You saw it in 2015 and 2020, but you did not see it off this low. This has been a very extended low.
Okay, so sorry, Milton, I just want to interrupt because I want to make sure I get it. You're saying that when a stock market bottoms and then viciously surges, I think, as it did in October of 2022, and as done in other bear markets, that is a sign to buy or back test.
It's one of the indicators of a market low. It did not take place this time. We look at turning points. By turning point, we look at indicators, that suggest a turning point on a specific day. This indicator is a 5-day indicator. The 5-day rate of change in the S&P 500 at major market lows, I don't want to say always, has nearly always exceeded 7.4% on a 5-day basis. The highest we got this time was 6.4% off the June lows, I believe. We did not get 7.4%. We may still get it, but it's not as close to the low. You usually get it really within days of the low. That's one thing that's lacking, but nothing is perfect. We have so many indicators that gave us buy signals. We have over 60 indicators that gave us buy signals since the October lows. We actually preceding the October lows, since off the September 30th lows. I'm just mentioning one of the things that has not yet signaled. It may yet signal, but it has not yet signaled to this point. That's something I want to mention. But since you asked me for the process, my process is to find indicators that signal within days of a low. This is one of the type of indicators that usually signals within days of a low. It happens to be did not signal during this particular market. Now, I want to suggest that most analysts, really all analysts, are making a very, very big mistake about this market. First of all, there are many bears out there who think the lows aren't in yet. They may be right, but we don't mind if the lows aren't in yet as long as we catch the rallies within the bear market. We think the lows are in, but many analysts don't think the lows are in. We think the lows are in. Secondly, we don't think the market made its major low in October. We actually think the major low was in June. The panic to the downside did not take place into the October lows. The panic into the downside took place into the June lows. And contrary to what we expected by fundamental analysts, the exact day of the low, which was June 16th, 2022, was the exact day that the Fed first raised interest rates by 0.75 of a basis point. Now, why do they call that the day of the low? The S&P has not declined more than 3% off that low of June 16th. Well, people are acting as if we're in a major bear market, and the market has continued lower and lower and lower into October or into November, into December in the NASDAQ. In reality, the Russell 2000, which is the broad index 2,000 stocks, the low cap stocks, they are 2,000 stocks, never got below its June 16th low. The S&P never got below its June 16th low by more than 3%. Now, we use in our analysis, we use a threshold of 3.75%. In other words, if a market makes low historically and held that low within 3.75% below that low, that is considered a test. So we had two tests off the October low. We had an initial test in September 30th. We had a secondary test on October 12th. And each of those tests took place within 3% of the June low. So we consider the market actually bottoming in June on the day that the Fed first raised interest rates. Now, of course, not only did the Fed raise rates on the short-term rates, long-term rates also increased dramatically since June. Yet the stock market has held the June lows. There's major underlying power in the stock market. The stock market is not collapsing the way people would expect it to collapse, considering recession, considering interest rate rises, considering don't fight the Fed. So we have many reasons to be bullish on the market, and the market itself is telling us, hey, we did not decline. Why did we not decline in the face of a rising interest rates, both short-term and long-term, and in the face of economic recession? Now, people are wondering whether there will be a recession in 2023. I don't understand that question. We had a recession in 2022. We had 2 consecutive quarters of negative GDP, which, I'm in the business for a long time, nearly 50 years. By us, that used to define a recession. Now, of course, the NBER hasn't made it official, but they'll probably make it official and say, yes, we had a recession, not in 2023, but in 2022. But one thing we've discovered, the best time to buy stocks is during a recession. The worst time to buy stocks is when the market is anticipating a recession. So even if there's a recession in 2023, there's no reason to be out of stocks. And in fact, the fact that there's so many fundamentalists out there that are afraid to buy stocks because of the impending recession, that allows us as technicians to get into the stock market while most people are fundamentals are not yet in, and that's why we get in early.
Under your framework, the recession has already happened. That's
yeah, it's already happened. Sure, it's already happened, and now we're coming out of the recession the way I see it. But even if I'm wrong, the recession is going to start tomorrow. The market has already bottomed. The market's bottomed early in a recession or sometimes before a recession. I mean, people were anticipating this recession, of course, for the last 9 months. And some people anticipating a depression, depressionary collapse. I mean, you see it all the time. You look at Twitter, and I'm sure you've interviewed many people who are totally think the whole world is going to collapse. Now, I have a theory here that let's assume the world will collapse. Let's assume we're going to go from the major inflationary period we had for the last year into a major deflationary, depressionary period ahead. Well, when economies shift from inflation to depression, you have a Goldilocks period. That shift from inflation to depression gives you a period that looks like, hey, it looks like stability. Inflation's coming down, it's flattening. People don't realize it's heading for deflation, but that period is a period where stocks should have blow-off action. I mean, you realize if you go from boiling hot to freezing, there's one period when it's comfortable, right? So even if you're going to have a major depression, which means a deflationary depression, since you're coming off inflation, be one short period of time, maybe last 6 months to a year, which things seem to be pretty good. And that's the time of the market will rally. So I'm not suggesting that these pundits out there who are very negative on the economy are wrong. I could see a Great Depression beginning in late 2023. That doesn't mean the stock market is going to go down. The Nasdaq has already gone down 35%. The semiconductors have already gone down over 45%. They've anticipated something, and now we may have a period that looks kind and gentle, even though it may be heading for a depression. No, I'm not projecting that. I'm just trying to, even those pundits out there who are looking for depression and they have to get out of stocks, they're really wrong, because when you shift from inflation to depression, the period in which stocks do well, and I think you're going to see that in early 2023.
Well, Milton, you definitely are right about the following, that the broad S&P 500 index has held firm relative to what many bears, myself included, would have expected. Yes, Carvana's down 99%, and individual stocks that are speculative have collapsed. However, the broad index, whether Russell 2000, S&P 500, have been very robust, and there is this period of that people are calling transitory Goldilocks, where all risk assets, including gold, Bitcoin, everything is going up. I mean, as we're recording on the morning of January 24th, that is the play in the market. Milton, if I were to ask you what because a lot of people compare the bear market of last year, whether you want to call it a bear market or not, to the .com crash from 2000 to 2003. Mm-hmm. And that was a brutal sort of shedding of speculative excess that took many years to unwind. Yes. What about the past year's price action that you've seen that you think is more bullish than a lot of the bears think is stronger than what you saw in the 2000s? Because you were a veteran of the business, you've been paying attention to these things for a long time.
The question is, why is this different than 2000? Question number one. Yeah. I'm going to answer that question. Before I want to point out that you gave a very nice history. We both gave a history of why this market looks stronger than you'd expect. We're forgetting to mention European markets. I mean, European markets are, I think the UK is near an all-time high. Let me just check that. UK index is, and UK index is approaching an all-time high. Its high in 2018 was 7903. It's currently 7765. So it's not just U.S. markets that are very resilient in the face of war in Ukraine, in the face of energy shortages.
Yeah. And as you said, the Chinese market is absolutely on fire. I mean, up something like...
Yeah, and guess what? We were the only ones I know that got in the day of the low. Yeah. Because the only ones I know that do turning point analysis. Most people out there need crossings of the 50-day to the 200-day, and they need confirmation. They need trend lines to be broken. You do that, it's a loser's game. Everybody's doing the same thing. It's really another way of saying, I will invest when I'm comfortable. That's really what they're saying. You have to invest when you're not comfortable, but that's also a loser's game. Great Depression, there are many days where you're not comfortable, the market's any lower. You have to have indicators that are built to find these turning points. That's what we've done. I'm not a young man. I've been in the business for, I don't know how many years, but let's say more than 40 years. And I originally started out as a strict fundamentalist. And I realized, hey, everyone else is a fundamentalist, and no one has an edge over the other. But what I did is I created my unique form of technical analysis. Now, why is it not like 2000? First of all, I don't know. It's not like 2000. As I say, maybe we'll have another 50, 60, 70% collapse in the NASDAQ. I don't want to make projections, but I would just say so far it doesn't look 2000. Number one, the 2000 period had two recessions over the period. People don't realize that. If you actually look at the data, there were two sharp short recessions from 2000 to 2003, and people are still debating whether we had a recession yet now, number one. Number two is we're forgetting, and we should not forget, that from February to April, beginning of February 2020, central banks all over the world went crazy injecting liquidity into the world economy. Now, they didn't start doing it that. They started injecting liquidity in the world economy in 2008, 2009, 2010. They did it for over a decade, but they had a blow-off, I call it a blow-off in central bank policy. They just went crazy in injecting liquidity. Unbelievable. I mean, you had Germany having 0%, negative 0%, negative long-term interest rates. I mean, it's just crazy. You know, you lent money to the government with the guarantee they'll pay you less money than you gave them. I mean, it's absolutely weird. And that liquidity has not yet been drained. Let's put it that way. Liquidity has not yet been drained. So probably the reason why these markets did not decline as much as they have, the reason why the UK market is approaching an all-time high is because the excess liquidity that was injected into the market is still having a positive effect on stock prices, which prevents it from going down as it should. And despite the fact that central banks worldwide are claiming that they drained the liquidity, they really haven't drained the liquidity. We still have a what you call an inflationary blow-off. So I think that and that's another reason why it's not like 2000. Like in 2000, they actually were lowering rates, were raising rates for a while until finally you had a collapse. And no two markets are the same. I think there's really more speculation in the year from 2000 2008 on the broad market than you had currently. But you mentioned Carvana. You know, Carvana is a great example. I know some great intelligent investors, one of the greatest investors in the world, who had a huge position in Carvana. Of course, he got out of it because he's a trader rather than being stuck with a position. But some clients of mine who are the greatest investors in the world who got caught up in some of the hype in some of these stocks over the last year or so. I was one of the first people to recommend Tesla, by the way, and I got out way before the blow-off in Tesla. I actually had charts going back when Tesla first went public showing that the action off the public offering was almost exactly similar to the action off the Cisco's public offering. As you know, Cisco was the greatest stock of the dot-com boom, and Tesla is the greatest stock of the latest boom. So they actually, although I projected that, I got out early, but there are comparisons, but I would say no. So far, the market doesn't look like it did in 2000. But yet, it may turn out to be worse than 2000. I mean, I know many intelligent people, analysts out there, say we have another 85% decline ahead of us. But right now, we're long. Right now, we've been saying the market bottomed in June. We say the market made a secondary test in September, a secondary test in October. Nasdaq made its low in December. We have so many buy signals off those lows, but there's no reason to be, at this point, to worry that the market's going to decline. If it does decline, maybe the decline begins in the middle of next year after we're up another 20 or 30%. We made an official projection for the S&P 500 of 4650 sometime in 2023, and we're sticking by that. We think we'll see 4650, and we make projections based on the history of our indicators. We have so many indicators that generate buy signals, so the median return of all the indicators would be 30% off the October lows, which takes us roughly to 4650.
So you said, unlike in the early 2000s, there's not going to be a recession. So that's a macroeconomic.
Two recessions. There were two recessions.
Right. But just sticking to the technicals, what about the price action now, whether it's advanced decline, whether it's trend, which I forget what it is?
You saw the classical market bottom in June. If you look at a chart of the S&P 500, and as we speak, I'm going to bring up some charts on my Bloomberg just to get what's going on. The S&P 500 had on June 9th, June 10th, June 13th, three down days, three gap down days, the kind of panic you see into a final market low. And on June 16th is when the Fed finally started raising interest rates by 0.75%. That was a panic low. And so everything else since then was a test. Of course, you had an initial bull market rally of nearly 14% into August 16th. We haven't exceeded the August 16th highs in most indices.
Sorry, say that again. Sorry, Milton.
August from the low in June 16th to August 16th. From that low, the S&P, I'll give you an exact number, the S&P gained some 18.93% intraday low to intraday high. We can see that the first rally in this bull market. Now, we want to see that the market exceed that level. People wanted the market to exceed the August 16th level. But I think it will. I think it will by a large margin. But basically, we see the price action is such that it's what's called a broad market base, a broad market bottom. First low June 16th, the second low basically October 12th. Nasdaq making an unconfirmed low, meaning no other index made a low with the Nasdaq except for the ARKK, but no other index made a low with the Nasdaq on December 28th. This is a broad low. Inflation is clearly coming down, and we wrote a piece in September saying inflation will come down. Based on again our turning point analysis, we looked at the June peak in inflation as the turning point in inflation, and for all these reasons, we think the market will be headed higher. But as I say, I'm not making a projection that there's a great new bull market, a great new economic growth. I think the liquidity that the central banks injected into the market hasn't totally been drained. I think that's goosing up markets. You look at European markets acting very well, despite the fact that most European economies are socialistic. They really shouldn't have long-term growth. In fact, many European markets peaked in 2007, 2008, never made a new high since then because socialism does not go along with economic wealth and prosperity. The United States is on the path to socialism, not quite there yet. So I think that we'll still be a leading market, although people are arguing we won't be a leading market because we've outperformed for so many years. We outperform because we're capitalistic. Capitalism will outperform socialism hands down over any period of time you look at. But now maybe we're moving towards socialism. That won't happen. But at this point, we're bullish on U.S., we're bullish on foreign markets, we're certainly bullish on China. Japan has some problems, and we're bullish on Japan as well. Now, Japan, its market peak was 1989. Can you imagine? People talk about, Jeremy Siegel, I don't want to mention names, but he talks about, stocks always do well over the long term. Well, Japan had a long term from 1989 to now. They bought at the peak of 89. It's certainly not doing well. So the reality is that you can't just make any broad claims. Stocks do well over the long term. Basically you have to look at markets day to day. And at this point, markets worldwide really, really look good. Why? I could speculate that we're coming out of recession, we'll have some economic growth, but most likely the liquidity injected is still there. And maybe sometime in the future, the liquidity will be drained and we'll see a major collapse, a major depression, but we're not there at this point.
Mm-hmm. And so the strength that you're seeing in terms of the technicals is, you said, a broad-based bottoming. So
let me give you some of my indicators. Okay, now, of course, we have our clients are mostly how do you put it? We don't have retail clients unless they're very wealthy individuals willing to pay what we ask for. We ask for quite a high sum. I only started the Twitter account. I never was on Twitter. You said you see me on Twitter. I only started Twitter in order to give people a flavor of what we do, but we're really only responding to institutions that contact us through Twitter. There are many institutions worldwide. We don't have a large sales force, so many institutions worldwide weren't able to contact, or maybe we contact by email and they ignore email. So I figured the Twitter account will give us some flavor of what we do. And we've gotten a lot of feedback from mostly retail, but some institutions. That's why we're on Twitter. We're not trying to give away our secrets on Twitter. Twitter is maybe only less than 10% of the indicators we look at. But for example, I'll give you some idea of the kind of indicators we look at and kind of thing that signal just since October. For example, TRIN. TRIN is a measurement of downside volume versus upside volume in relationship to the number of issues that traded up and down in the day. In other words, a TRIN above 1 basically means that there's more volume in down stocks on a relative basis than up stocks. A TRIN below 1 means there's more volume in up stocks than there is in down stocks. Now, TRIN, our indicators look at TRIN extremes. Our turning point indicators are looking for extremes in TRIN. We really don't care about the general levels of TRIN unless TRIN is at some sort of an extreme. Now, you had a TRIN above 4 on October 3rd. Now, October 3rd was just a couple of days after September 30th low. As you know, many of the broad indices in the United States bottomed in September as opposed to the October 12th low of the S&P. I think the mid-caps bottomed September 26th. Anyway, October 3rd, just a few days after September 26th low in the mid-cap index, TRIN was above 4. Now, TRIN was only above 4 10 times before in history. Each time TRIN was below 4, each time except for one time, it was 9 out of 10 times, it was a major bull move followed. Looking at the median gain within the next 12 months, maximum gain within the next 12 months over all of these previous 10 times in which TRIN was above 4 is 21.84%. There's only one instance where it's only 8.58%. So, but the median is 21.84%. So That was a turning point indicator. It signaled within a few days of the September lows in the small cap indices. And of course, within a couple of days before the final low in the S&P, but just a couple of days after the September 30th low, as you know, the final low on October 12th was only 0.25% below the September 30th low. So it's really, it's a flip. You can either say the market bottomed on September 30th, or you could say it bottomed on October 12th. We say it bottomed on June 16th. But no matter how you look at it, September, October was a major low for the S&P 500, and we got this signal October 3rd within days of the low. There's a trend above 4. So again, what the trend above 4 means, on an overwhelming basis, volume in the stock market was on stocks that were down in the day, which means there was panic selling in stocks that were down in the day. Now, panic selling takes place at the end of a move, at the end of a bear market, and that actually took place October 3rd, 2022. Now, on October
Milton,
4th,
so I'm really sorry to interrupt you, but just okay. So trend, the higher the trend, the more volume there is in the stocks that are down
relative to stocks that are up. In other words, we're looking at a ratio of the number of stocks down to the number of stocks up. Like, for example, if there's 2 times as many stocks down on the day than up on the day, 2 times as many stocks down on the day, and there's 4 times as much volume on the down stocks and the up stocks, that'll give you a trend of 2. Because the ratio of volume in the down stocks is twice as much as the ratio of down stocks to up stocks. Got it? Ratio of 4 is a big extreme, only seen 10 times in the past. Got it?
Got it. Okay, and why is that a bottom signal? Because isn't it true that sometimes people
panic? It's a sign of panic. Right. First of all, you realize you don't see this often. Historically, you've seen it at bottoms, number one. But secondly, the market bottom is late September or September 30th. The market makes a low in the S&P. All of a sudden, the market's rallied a couple of days, and during that rally, the stocks that are down shows an increased volume in selling. That basically tells you psychology, and the action is panic selling. Panic selling represents a low. If you're going to panic sell, you should panic sell on January 4th, 2022, day after the top. That's when you should panic sell. You don't panic sell after the S&P is down 25%, Nasdaq down 35%. This is a sign of a low, and historically it's been a sign of a low. I said 9 out of 10 times the market continued straight up after those signals, and the median gain has been, after that type of trend, has been, as I said, 21.84% within the next 12 months. Now that's not enough. That's just one signal. A signal, we have many, many signals. That's just one. On the following day was an update in the market, and the S&P showed 293 times as much upside volume as downside volume. It's October 4th, 2022. Again, let me say this. Upside volume, meaning the volume in stocks that were up on the day, on October 4th, just the day after a trend of above 4, meaning just the day after this panic selling in the stocks that were declining, following day, there was 293 times as much volume in the upside stocks as downside stocks. I think technicians call that a reversal. When they have panic selling, the next day you show panic buying. You see that in commodities all the time. When you see spike lows in commodities or spike peaks in commodities, when you see increasing volume on the downside followed by increasing volume on the upside. Here, I'm talking about the ratio of volume to the downside, the ratio of volume to the upside. Anyway, it was 293 to 1. Now, that's such an extreme. It only happened once before. And it's very difficult to make an indicator have something that only happened once before. So we decided to, we decided this probably 15 years ago when we created this indicator, and we used the 100 to 1 level as our threshold. So we look at how often in the past, if you excuse me, I'm going to take a drink, I'm a bit hoarse.
For sure.
How many times in the past did you see 100 times as much upside volume in the S&P on the advancing stocks versus the volume in declining stocks? And that only happened 4 times in the past, and the median maximum return within 12 months was 30.45%. You never had a bear market to follow. You never had a significantly lower low. The maximum low, and you never saw a low of more than 6% below the prior low. And the returns, give you an example. In 2018, you saw a return of 31%, 2012, 29%, 2011, 22%, 1982, 56% within 12 months. The median is 30.45%. So, this is just a bullish indicator, and it's a reversal indicator. I'm not even considering a reversal. If I create an indicator, when you see a trend above 4, followed by 100 to 1 upside volume, the answer would be 0. First time I ever saw this type of reversal. It's such a major reversal. But just looking at the day, we have 100 to 1 upside volume, the S&P 500. It's a buy signal, and we're long based on this buy signal.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. Milton, I've heard it said that the most vicious one-day rallies are within bear markets. So, during 2008, 2009, that's when you have the S&P 500 up 4 or 5%, when pretty much every stock is up. It's not during a bull market where every single stock is up. To what degree is that true?
That is very true. That is very true. But that's the problem. People who follow markets look at the obvious. And the obvious is that when the market is showing a great one-day return in a bull market, in a bear market, it's usually a failed bear market, beginning of a failed bear market rally. It's true. We're not looking at the price change. We're looking at the volume relationship, which is not obvious. You have to have a computer, and you have to have data. We have 30,000 indicators we follow on our computer. I can't follow it on my own. I try to, but I can't.
You can only follow 9,000 in your head.
Whatever. We have our computer every day spits out the aberrations. This is an aberration. So yes, many times during bear markets, you saw the market. Let me see what the market gained on October 4th. Let's give you an example. Let's check the index. I'll give you an example. October 4th, 2022, the S&P 500 gained 3.06%. That's not, you've seen that before, right? Let's see what the Nasdaq did. Nasdaq gained on that same day, October 4th. Nasdaq gained 3.34%. That's not, you've seen that before. It doesn't stand out. But what does stand out is that the volume was 293 to 1 on the upside. So we're looking for what's not obvious. So I agree with you totally. Bear market rallies very often have one day great rate of change. That's not the signal. The signal is looking at something that's not obvious, which is the ratio of upside volume to downside volume. And this is what gave us our buy signal. So I appreciate your question. It's a fair question. Not only is it a fair question, it really highlights what we do. We don't look at the obvious. We look at the not obvious. Not obvious is that you had a 293 to 1 upside downside volume ratio. In the past, never led to a continued bear market. In the past, twice in the past, the market didn't even decline more than 0% below that day. But generally, I gave you the years 2082, 2011, 2012, 2018, and October 4th, 2022. That's another indicator we saw off the October lows. Now, they give you another indicator, only signaled once before. So you could really discount it because something that only happened once before. Most people will say that's not an indicator. But we say we're looking for this type of aberrations. If it happened once before, and when it happened once before, it was at the bottom of a major decline, and now at the after a major decline, you see this indicator. Perhaps this is significant. Now, you're not going to know it's significant maybe until decades later, or centuries later, or millenniums later, when analysts in the future are going to track this indicator, because we're publishing a book hopefully at the end of this year, maybe early next year, of all these 30,000 technical indicators I've created. Of course, we're not going to put all 30,000 in the book. We'll maybe have 100 or two. But we're going to show indicators that we've used over the last 40 years or last 30 years since I've been a technician to find turning points. And one of them will be when on a 3-day basis, 98% of the S&P 500 is at a 3-day high. In other words, how often have we seen more than 98% of the 500 stocks in the S&P 500 closing at a 3-day high? Right. As people look at 1-year highs or 6-month highs, we're looking at a 3-day high. Remember, compact turning point analysis. It only happened once before. Of course, it happened on August 29th, 2011. Now, that was a few days after a major market low. Now, that wasn't the final low. The prior low to August 29th, 2011 was tested by 1.1 1.81%, made a low in October. But basically, it was at the area of a major market low, suggested we're near an area of a low. We had that same signal October 4th, 2022, where on a 3-day basis, 98% of the S&P 500 made a new high. Now, of course, as I say, I understand why people will ignore this. They'll discount this. If this is all we saw, we wouldn't trade based on it. But it's kind of aberration, which we believe in the future will suggest. And we believe 100 years out from now, when people follow this indicator, they'll find 4 instances or 6 instances, and each of these 6 instances took place perhaps at near a major low. Now, of course, market structures change. We have to remember that. With the proliferation of ETFs and program trading and future, when I get into the business, there are no S&P 500 futures, no such thing. There certainly were no ETFs. I mean, there's no way to buy all 500 stocks at once. Even institutions wouldn't buy all 500 stocks. They couldn't. And even if they wanted to, their boards of directors would tell them, well, you can't buy stocks that are doing poorly, which usually are the best performing stocks over the next year. Like I remember in 1974, where they started making the S&P 500 index, early in the index, they started making index funds. The first index was left out Chrysler and a couple of other stocks because those stocks do so poorly. How can you put that in an index fund? You can't have a 500 stock portfolio that includes Chrysler. And of course, Chrysler proved to be one of the best performing stocks of the next decade. Not that it's the greatest company, but it's so oversold that it did well. So the point being is we couldn't buy indexes. Now you can buy indexes. There are ETFs, there are programs, there are futures. So I can't say what you see today will take place in the future because I don't know how the market will change. I mean, it went from trading in eighths to trading in pennies. It also affects some of the indicators. But I still think that the fact that you saw 98% of stocks at a 3-day high only once before in history at near a major low, and you saw it again October 4th, is bullish, and so far it's been bullish. That took place within days of a low. That's another indicator we look at. I could go through many more indicators. I don't mind. I think it's pretty interesting. What do you think, Jack?
Yeah, I want to ask you about breadth, which I think is if there are 500 stocks in the S&P 500, if 251 of them are up, that's not that strong breadth. But if 495 of them, that's very strong breadth. So what is the breadth within the S&P 500 right now or over the past few months? And also that incredibly rare trend reading of 293 times more volume.
Upside downside volume. That's a trend ratio of upside downside volume. We've seen many upside downside volume signals.
Sorry, Milton, my question is how dependent on that is the breadth that on that day, 496 of the stocks or something.
It doesn't matter because the ratio, let's say you have breadth, let's say you had there were actually 505 stocks in the S&P 500. People don't realize that. Let's say 504 stocks were up and one stock was down, right? So you'd expect the ratio of upside value to downside value to be 504 to 1, just like the ratio of upside issues to downside issues is 504 to 1. But that's not the case. You see, the case is you have to, for example, a large stock like Apple will have greater volume than a small stock. Mm-hmm. So there are many, many nuances to what we're looking at. So yes, the 400 to 1, the 293 to 1 upside downside volume is an aberration that should not have taken place unless it's a major change going on in the market. It's just too rare. It's not common. And the fact is that there's ETFs trading has not led to 293 to 1. You don't see an increase in the, as I say, if you look, you don't see an increase in upside downside volume ratios to that extent since program trading has begun, ETF trading has begun. But let's talk about breadth in general. We had on October 28th, we had our first breadth buy signal of this market. October 28th, 2022. Not just looking at the S&P, we look at the S&P and we add small cap issues to it as well. It's a broad index we look at. And that showed on a 10-day basis, it showed 10 times as many upside. It showed 2.04 as many stocks to the upside as to the downside on a 10-day basis, which is a breadth thrust buy signal. Now, many, many bull markets in the past have begun with this type of a buy signal. 1962 saw it, 1966 saw it, 1970 saw it, 1974, 1976, 1982, 1984 did not see it, but a bull move in 1985 saw it, 1987, 1991, 1992, 2003, 2008, 2009, after 2010 flash crash correction, you had a 2-1 upside downside value. You saw a failed signal in July 2011, the only failed signal we have. But you saw it again a buy signal in 2013, a few days off the low. You saw it in 2016, a few days off the low in the NASDAQ, and so on and so forth. Well, you saw that signal October 28th, 2022. And we've seen 37 signals in the past. The median upside gain over the next 12 months, maximum gain has been 20.16%. So yes, you've seen breadth. Now we're not looking at, most people look at the advanced decline line for confirmation. That's a nice thing to look at. We look at it too. We have no indicators based on the broad advanced decline line for a few reasons. First of all, because the broad advanced decline line is looked at by everybody, so it's an obvious indicator. Obvious indicators don't work because everybody looks at it. Secondly, we're looking for turning points. For turning points, you need concentrated indicators. So the 10-day concentration of the AD line gave us a buy signal October 28th. Now, how many days was October 28th from the low of October 12th? Let's count it. October 28th was 1, 2, 3, 10, 11, 12. Only 13 days off the low. Now, we like to find a buy signal within 7 days of the low, but when you have a 10-day breadth signal, you're not going to get it within 7 days of the low. So we got it within 13 days of the low, which is fine. So that's one of the breadth buy signals we got. We also got another breadth buy signal here in January. To us, it's a second breadth buy signal. Most analysts consider it the first breadth buy signal of the bull market. We got a signal on. Let me give you the exact date. We got a signal on January 12th, where the Nasdaq 10-day advances over 10-day declines of 1.70 to 1. That has happened in NASDAQ 8 times in the past. The median maximum return in the S&P 500 over the next 12 months has been 21.35%, with only one failed signal. The failed signal, not that the market went down, it just didn't gain much over the next 12 months. It gained 5.67%, although it only declined 5%. It was sort of a balance. But this is a great indicator. 7 of the last 8 times, it led to major bull moves, and the median gain, including the gain of 5%, was 21.35%. And then we also had the same day, we had a 1.9 to 1 10-day advanced decline line in the New York Stock Exchange, which is a double of the signal we had back in October. October, the signal was not in the New York Stock Exchange, it was a broad index, it was the S&P 500 plus small caps. The signal on January 12th was one signal for the NASDAQ, another signal for the New York Stock Exchange. But these are breadth indicators, concentrate indicators, turning point indicators, which are bullish. Now, fortunately for us, most people do not trade based on this type of action. They need the fundamentals to be in place. By the time the fundamentals are in place, it's too late. I mean, people are still worrying about a recession next year. Until they're convinced there's no recession next year, they're not going to buy stocks, no matter how many of these indicators we get. We've had, I think, 64 buy signals since October 3rd. Let's assume that over the 64 buy signals, 10 of them are bogus. Let's say Milton Berg just fudges his numbers. Let's say that's true. Well, you can check my numbers. Or let's say 10 of them happen to work in the past, but they won't work in the future. That's possible. But we have 64 indicators constructed the way we construct an indicator giving buy signals. Very little reason to believe that the market's going to continue lower.
And Milton, sorry, how many sell signals do you have?
Well, can you name a sell signal that you've seen in the last 6 months? Can't name one.
So you have 0 sell signals. 0
sell signals. I have what you call potential sell signals. For example, just at yesterday's close, my computer spit out the VXN deviation from trend sell signal. But guess what? That sell signal has had a remarkable record in calling bear market rally tops. But it's a terrible record early in bull markets. Basically, what VXN sell signal tells you that the VIX on the NASDAQ, which the VXN, had a sharp 8-day decline. It did have a sharp 8-day decline. It declined 18% in 8 days a few days ago. And that often takes place at the top of bear market rallies, but it all takes place early in bull moves. Since my bullish indicator tell me early in a bull move, I can't call that a sell signal. I call it a potential sell signal. I certainly can't act on it. I can look at it and think about it and get nervous, but I certainly can't act on that indicator because it has many, many false signals. But you tell me, I look at all the bears out there, and I say, tell me what? I mean, you've seen that. You look at Twitter. I mean, I've never looked at Twitter before. It's very enlightening to me to see how so many people out there base their investment decisions on information that really does not have a historical basis. For example, anticipation of a recession. I mean, how many economists are successful anticipating recession? Why should the typical retail investor out there not be invested because his advisor tells him there's a recession ahead? I mean, how does his advisor know there's a recession ahead? I happen to think we've seen the recession, we're coming out of it. But maybe I'm wrong, there's a recession ahead. How many times have markets rallied when there was a recession? When people thought there was a recession, many times. And many times the recession turns out to be a slowdown rather than a recession, and the market rallies.
For sure. And a perfect example of when the price action was ahead of the markets, and by the time the economic data showed good news, it was already too late, was March and April of 2020, when the economy was in a recession worldwide, and various economic indicators were at their lowest level ever, particularly the labor market. But the economy rebounded very sharply, in part because of monetary and fiscal stimulus, in part because people were buying a lot of things from home. But that's a perfect example. My question to you, Milton, is I feel like you have a lot of respect for indicators that have good track records. I would propose to you that the yield curve inversion, whether you want to look at the 210 spread or a variety of other spreads, has something pretty close to an unblemished track record of forecasting
recessions and forecasting bear markets.
Yes.
Well, guess what? I did a great job of forecasting this bear market. We had a bear market. The Nasdaq just bottomed in December. So the yield curve forecasted a bear market. That's great. That doesn't tell you have to have a positive yield curve before the market bottoms. That's not true. You get a market bottom during a negative yield curve. So yes, I challenged you to give me a negative indicator, and your answer was yes, the yield curve. Let's look at the history of the yield curve. Give me a second. I happen to have the yield curve chart right in front of me someplace.
And just for the audience, a lot of people, I particularly saw on Twitter, when the yield curve inverted in the spring of 2022, they were saying, oh, this is incredibly bearish, or recession is happening now. Whereas I'm looking at a chart just from the St. Louis Fed that actually yield curve inversions happened well before the recession, the first date, suggesting that it's possible the recession hasn't even started yet, and that we're headed into one. And also, I'd also throw out Milton, that if we already had a recession, the unemployment rate would be historically low.
So we're focusing on markets, but let's talk about the economy, yield curve. First of all, I'm looking at the 3-month T-bill yield to the long-term 30-year Treasury bill, right? Okay. So the yield curve just inverted a couple of months ago. That yield curve just inverted to the level below zero a few months ago. And that anticipated a recession for the 2020 recession. It anticipated the 2008 to 2010 recession, anticipated the 2002, 2003 recession, 2002 recession, anticipated a slowdown in 1990, and so on and so forth. Okay, but as you say, it anticipated a recession. We don't know whether the NBR will declare that we had a recession or not. We don't even know that. Maybe they'll declare we had a recession. But the way I see it is, looking at my chart, when the yield curve inverts, when you get to the extreme of the yield curve conversion, you're pretty close to the extreme in the stock market low. So I have no reason to think that just because the yield market curve, that the 35% decline in Nasdaq is not sufficient to set up the grounds for a bull market. I have no reason to say that. You may argue, but I have no reason looking at the chart of the yield curve to suggest. Now you ask a very good question. How can I suggest that we already had the recession if employment is so great? Well, the employment rate, there are many components to the employment rate. One component of the employment rate is how many people consider themselves unemployed and are looking for a job. And, due to the, as I said, the stimulus that the governments worldwide generated, the blow-off stimulus in 2020, including fiscal stimulus, allowed many, many people otherwise be looking for a job to fleece the government of government resources and live off their welfare checks or PPP checks and so on and so forth. So part of the reason the unemployment rate is down is because people didn't need to go to work. Another reason is because, as I said, I think the stimulus is still there. I think the stimulus you saw in 2020 is still having an effect, which meaning that companies that were able to borrow at 0% and consumers was able to buy houses at 2.5% mortgage rates, I think that is still goosing the economy. That is still a positive effect on the economy. So therefore, maybe it didn't affect unemployment, and maybe unemployment will come down a bit. But your question is a valid one as far as the economy is concerned, and maybe it's a valid one as far as my thesis that we've already seen the recession. But I don't think it's a valid one that's to suggest that the market has not yet bottomed, because let's remember we saw a 45% decline in the stocks in the semiconductors. We saw a 36% or so decline in the Russell 2000. We saw 35% decline in the Nasdaq. We saw 99%, as you said, in Carvana. We saw the ARK speculative index, the ARKK
Down something like 80%.
80%. So, it's in the bear market. I mean, why anticipate further bear market? I got to tell you the truth. Not the truth, but there's one great analyst on Wall Street, I'm not going to mention her name, a very large following, who put out a report on October 12th, October 24th, 2022, saying, avoid China. Momentum is too low in China. And I wrote an email to this analyst, say, listen, China is down 61%. It's down 12% in one day, in the last day. And you are always willing to say buy the S&P on any day is down 5%, because it's oversold. Why are you not willing to say buy China on a day it's down 12%? I said, in fact, my technical indicator is suggesting that this is the exact low. It turned out to be the exact low. So when you look at look at markets is different than look at the economy. In many cases, now, as I always say in interviews, I always say when I speak to my clients, on any given day, going back to the 40 years I've been in the business, on any given day, I can make a bullish scenario or bearish scenario. On any given day, I can tell you why we're headed for a Great Depression, headed for a recession, or headed for a slowdown. On every given day, I can tell you why we're headed for a boom, a moderate gain, or inflationary gain. It's always there. There's always data there, especially when you're trying to anticipate a future change. In other words, so many analysts, rather than look what's happening now, the Fed's going to loosen, the Fed's going to tighten. Well, you don't know what the Fed's going to do. There's a bunch of people, academics, going to make a decision. Nobody can know what they're going to do. You can't base your investment decisions on what you think the Fed might do. How about basing your investment decisions on what the market is telling you, what the data is telling you, what the Fed has already done? Now, to me, the Fed has already raised rates 0.75% numerous times. Inflation has already come down since its peak in June. The rate of inflation over the last 5 months is approaching 2%, 2.4% or so. And I'm looking at what I see, and the indicator telling you we're in a bull market. So why should I fight it? Yes, I challenge you to give me a negative indicator. You gave me a negative economic indicator. It's not a negative stock indicator because the stock market is already down 30% or so. I'm challenging you, I don't mean you, Jack. I'm challenging the bears out there to give me an indicator that has recently suggested that we're headed down another 35%. Now, there's great analysts who use valuation. The market is so overvalued, and the fact that we're down 30%, we're still overvalued. And they said they projected a 90% decline in 2022. They projected that over the next 6 years, the market will be down 90%. We're only down 35%. So you haven't met their projections. Okay, that's true. We haven't met their projections. That doesn't mean the projections were correct. Right now, I see nothing suggesting that the market's going to collapse. Now, you can say there's a bear market rally, the S&P, the Nasdaq's up 14% off its lows, but these are the same people who said bear market rallies and the Nasdaq can approach 20 or 25% before they peak. So why are they suggesting the 14% rally is sufficient? I don't see, and even that's not an indicator, that's just a guess. Well, maybe it's a bear market rally, so it's over. I want to see an indicator suggesting the market's headed lower, and I don't see any. Now, I did point out that the VXN suggests if we're in a bear market rally, it suggests the top. And maybe that's true, we can't act on it because it also it signals early in the bear market. I see nothing in the indicator picture that suggests a continued bear market from here. I see many, many things in the indicator picture that is compelling me to be long the market.
I would go back to the indicator of the yield curve, and I'm struggling to find a recession that began before or during the yield curve was still going down. I'm looking at the 2-10 spread, and I'm also looking at the 3-month, 30-year spread, and it appears to me that before every recession, the yield curve re-steepens again, either because long-term interest rates are going up, or more likely the Federal Reserve is cutting because economic growth is so weak.
So what do you suggest? You're saying that since the yield curve is down, and since we have not had a recession yet, that the recession must be ahead of us, and therefore the market's going to go lower. Well, number one, I say we don't know if we have a recession yet. You're right. The unemployment does not suggest we had a recession yet. But I don't know. I see many fundamental indicators suggest we had a recession. I'll give you a couple of them right here. Okay, production index. The Institute for Supply Management Production Index is now at a recession level. We're now declining. We're at a level of 48.5, and that usually takes place during a contraction. In fact, some of the great market analysts that I use said that their recession indicator gave a signal in October, and that suggests we're in a recession based on the Institute for Supply Management Production Index. It shows production is contracting. So there are reasons to believe we're in a recession based on that, not in employment. But there's reason to think we're headed higher. You know, the hedge funds at the end of December were shorter than they were at the lows in 2020, shorter than they were at the lows in 2015 and 16, shorter than they were at the lows in 2011, but not as short as they were near the lows in 2008. So hedge funds are very, very short. Now, why are they short? You know why they're short? They're short because they're looking at the inverted yield curve. They're not looking at the market indicators. But, you know, you want to fade hedge funds when basically they're short the market. And that's what, that's where we are now. I mean, the way you get the hedge fund sentiment based on the futures trading, you know, and the largest futures traders are net short to an extent that you haven't seen since 2008. That's the reason to be bullish. But I'm going to concede, yes, maybe I'm wrong, and maybe the recession did not yet take place, and maybe a recession takes place next year. But I only can concede to the maybe. Mm-hmm. I can't concede that there will be a recession coming up, because maybe we had a recession. So I can't concede that there will be a recession. I can say, yes, you're right, maybe there'll be a recession, but the market is telling me, A, either that there was a recession, B, either we have anticipated next year's recession, or C, maybe there won't be a recession at all, and the stimulus created by worldwide central banks, crazy stimulus for the 12 years from 2008 to 2020, it still has a positive effect, and I think that's the case. Or, as I said earlier in the interview, maybe we are headed for a Great Depression, but there'll be a Goldilocks period when you shift from inflation to depression. There's a period 6 months to a year that really looks great. I mean, as it was from 1928 to 1929, the Fed was tightening dramatically. The economy was moving from inflation to deflation. And it was a Goldilocks period, certainly for stocks, because stocks boomed in a final blow-off. So I can't say, I don't want to project that, great times ahead, but I will project great stock gains ahead. Don't be short. That's what I would say.
Right. Yeah. Well, as folks can gather, I have a more bearish view than you do, but I certainly concede that I could be wrong. And the price action has definitely taken me by surprise. It has not taken you by surprise. And very impressive that you nailed the Chinese low. I will say, Milton, I do agree with you. There are two things that you are quite constructive on that I'm also pretty bullish on, which would be China. I didn't nail the bottom. I got in later. And then gold miners.
Well, gold
in China have exploded higher.
Gold miners.
Yeah.
Now, I managed the largest gold in the 1980s, late 80s. I managed the largest gold fund in the United States. People aren't aware of that. They think I was basically involved in S&P, but I actually managed the largest gold fund. It was for Oppenheimer at the time. Oppenheimer Gold and Special Minerals. Now, gold is a very unique. Gold stocks, particularly, is a very unique asset. It's one of the worst. A gold stock, a company that mines gold. How do I put this? It's one of the worst businesses you could be in. Mm-hmm. Imagine if you had a pit with 1,000 gold bars in it, right? And imagine every year you take 10 gold bars out, and you list that as your earnings. It cost me $5 to climb into my pit, to take out the gold bar. And I'm selling the gold bars at $1,800 an ounce. Well,
and that's why the depreciation is so high. That makes sense.
Exactly.
Yeah. Okay. I was wondering why that is.
For gold miners to be successful, they have to constantly find new reserves.
Yeah.
Some of them are able to do it, like the great gold mines in South Africa. We had a tremendous undiscovered reserves, just way underground. But many of the gold stocks that we see that are in the GDX really have limited reserves, and really hoping they'll find additional reserves in the future. Having said that, gold stocks are a very volatile group, and they have historically tremendous rallies and tremendous declines. And we think that the gold stock index, since they moved along with the equity index, and since the equity index bottomed in this year in June, October, we believe that September 26 low in the GDX is a final low for the latest decline. GDX is up, was it some 48%? Now, unfortunately, I didn't trade it well. We got in 10% position near the lows in September, but when you had the first pullback, I lightened up to 5%. We're now up to a 10%, 12% position again in GDX. Unlike the MCHI, we got into the lows. In this case, we got in, but we got out, and we increased the position just in the last few days. But we think we're early in the bull move in the GDX and in gold itself. But of course, generally, the gold stocks do better than gold Although on a long-term basis, gold is a far better hold than the gold miners, simply because of the depreciation of the gold miners. You have to rely on management. You have to rely on the management being competent, and you have to manage on fraud. There's a lot of frauds going on because it's very easy to manipulate balance sheets.
Yes.
When you manage a gold stock, as opposed to when you manage a phone company or even a semiconductor company or whatever. Reserves. You don't even know what real reserves are. You don't even know what. It's very difficult to manage a gold mining company, and we have the GX is a basket of gold stocks. So we own that. Yes, very bullish on gold, but I'm surprised that you're bullish on gold and you're not bullish on stocks. I'll tell you why I'm surprised, because the gold market peaked in 2020. The GDX peaked in 2022. It's not its latest peak. Its actually peak was in 2011. It's actually it peaked in 2020. Its last peak, but the latest peak was in 2022. Along with the S&P, SP peaked in January, and the gold stocks peaked in June. The gold stock declined dramatically into September. It declined some 46% into September, and now it's rallied some 50% or so. So you see, it's moving along with stocks. When I managed the gold fund in Oppenheimer, I turned bullish on gold after the crash of '87, simply because gold stocks crashed along with the S&P 500. So I said, if they're moving along with the S&P 500 on the downside, they'll also move with it on the upside, which they did. So I would say, Jack, I agree with you on gold stocks, but I don't think gold is separate from equities. I think if gold stocks do well, equities do well. But of course, gold stocks should do far better than equities, because gold stocks didn't have the run-up that equities had into 2021. So GDX at this point is down 51% off its peak in 2011.
Mm-hmm.
So for that reason, GDX is more undervalued. Except remember, gold stocks is very difficult to value. It's not an easy game to play. But I agree with you. Yes, gold stocks is a place to be at this point. But I would say if you're bullish in gold stocks, you got to be bullish in equities in general. But I know I could be wrong on that. From 1930 to 1932. 1929, 1932, off the lows in 29, Homestake Mining, which is the premier gold stock, was up 1,000%, while the SP was down 85%. So there have been times in the past when gold stocks traded counter to equities, but that's not always the case. I know in the 80s, gold stocks and equities moved in the same direction, and again now in the last year or so or two, gold stocks and equities moved in the same direction. Realize something you don't realize, although gold stocks by Homestake Mining peaked, rallied 1,000% from 1929 lows to its peak in 1932, while the market was down 90% or so. Silver did not bottom until the market bottomed in 1932. Silver did not move along with gold. So, even gold and silver and precious metal stocks, they're not uniform. You got a real analysis to understand it, but you got me because I'm long GDX as you are. So we certainly agree about that.
There we go. Milton, my final, by the way, Milton, I just want to say, you mentioned your Twitter account. People should definitely check out your Twitter account at Berg Milton. Yeah. And, we're very blessed that we can, read your insights as they sort of.
Well, first of all, I can't give insights on a timely basis because my clients, I only give a tenth of what I give my clients, but I got to give it at a delayed basis because my clients pay me and Twitter account doesn't. Secondly, I have to admit, the only reason on Twitter, I'm not doing it out of benevolence. I'm not doing it to give people indicators that I spent years working on. I'm really doing it to try to generate leads from my institutional account. I don't have a big sales force. I'm a very small operation. I really sit at my desk. I work 24/7, trying to 24/6, trying to do my work and trying to come up with these insights. And we're just trying to expand our business. And we have a great business. We have some of the titans of Wall Street are our clients.
Yes.
But no reason trying to expand it. And secondly, since we're publishing a book on our indicators sometime late this year, early next year, Twitter is a way to get interest in the book. And believe it or not, though, if any book publishers out there, we approached one of the major financial book publishers. They turned me down, saying because I don't have a Twitter following. Well, I wasn't going to be on Twitter. I'm an institutional guy. But he said, okay. I said, I'll do him a favor. I'll get him a Twitter following. I just started a couple of months ago. I really only have about 9,000, 8,500 maybe followers, which is not a lot. But I don't even know I'm not going to spend my time trying to get a Twitter following. I want to spend my time trying to call the markets properly. But I appreciate you mentioning Twitter. If you have any institutions watching this, or any home offices, or any individuals that are willing to pay institutional type of money for research. But yes, I like to give a taste of my work on Twitter. but really it's just a small fraction of what we really do. And I appreciate you mentioning it. I appreciate this interview. I think the interview had gone pretty well.
I would say so too, Milton. And I would say
good job, Jack.
Thank you, Milton. I would say, what we've talked about in this interview is just a small fraction of your work. So, only your clients get access to that. Milton, I do have a final question for you, which is about bonds, the whole aspect of the yield curve, the 10-year note, 30-year bond, as well as perhaps, I don't know, the shorter end, the 2-year notes. What technical indicators are indicating about that? Because as you know, 2022 was one of the worst years for the Treasury bonds on a nominal basis and on an inflation-adjusted basis ever. I think on a nominal basis, it was very, very bad.
It was terrible, yeah. It was terrible.
Yeah, so what do you think about bonds? You're bullish on stocks. Are you bullish on bonds? And
this is in the 60s and 70s. When you had the inflationary period, he called bonds certificates of guaranteed confiscation because yields were never sufficient to compensate for inflation. And you bought a bond and they paid you interest, and the interest value of the interest you received went down year after year on inflation. I think bonds are again going to be certificates of guaranteed confiscation, but maybe for a different reason. Maybe because of inflation will be with us over the next decade, even though right now inflation is coming down. But more importantly, because maybe we're going to, this is another thing I talk to my clients about, and we really didn't touch upon this, but I happen to be a big deflationist over the long term. I think there's too much debt out there, and either the governments are going to inflate, and therefore they're going to default on the debt through inflation, or they may be forced to default on the debt through deflation, which means they won't be able to pay off their loans. So if that happens, then many corporate bonds out there won't be able to pay off the debt. So it'll be certificates of guaranteed confiscation because you really won't get your principal back. So yes, I'm negative on bonds over the long term. This short-term 1-year decline in bonds, I think, is just a signal to what we may see over the next decade or so. But again, I'm really flexible on this because I can make when it comes to bonds, you can easily make a bullish or bearish case. Really mostly depends on future inflation rates or deflation rates or disinflation rates. But I happen to be a deflationist because I think when Feds worldwide ease, they don't print money. They allow credit to expand. And when credit expands, ultimately credit has to contract. And when credit contracts, it's deflationary. That's another long story. Maybe we'll do another interview on deflation and inflation. It's not for this point. No, but the answer was no, I'm negative on bonds. They had a bear market. It deserves a nice rally for a while. But long term, I do not think we've seen the high in yield and the low in bonds. I don't think so.
Right. So this deflationary scenario that you see, Milton, I can see why that would be bad for corporate bonds, the loan market, particularly high yield, riskier stuff. But if we have severe disinflation as we've had over the past few months, so that inflation runs to 2% annualized, and maybe even below that, wouldn't that be a pretty positive environment for bonds?
If you want for government bonds, you mean?
Yeah, government bonds. That's what I meant. Sorry.
Well, I think the government, if the government was honest, let's put it this way: if the government borrowed in gold rather than in paper dollars, they'd be bankrupt pretty soon. They can't pay it off. I mean, they were bankrupt. And Nixon, when he closed the gold market, basically with declaration of bankruptcy for the United States. The United States used to have a treasury. You know what the definition of a treasury is? A treasury is where you store money. There should no longer be U.S. Treasury. It should be a U.S. debt ministry, because the U.S. doesn't have Treasury. The U.S. owes money all over the world. The United States used to be a creditor nation. When I was young, when I was first even in the business, the U.S. is now a debtor nation. There's no Treasury. So ultimately, if they be honest, they default. If not honest, they're going to inflate. If they inflate, the price of bonds will go down. If the price of bonds go down, that itself is deflationary, because all of the billions of dollars that people invest in bonds will go down in value in deflation, because if they're in inflation, so the price of bonds will deflate. So while you have an inflation, you have deflation in bonds. So it is really a catch-22 here. I don't see how the U.S. can get, worldwide governments, certainly the U.S. can get out of this. I mean, they claim they were about 120% or so debt to GDP. But if you include Social Security and you include the off-balance sheet debt, when you're more like 300% debt to GDP, there's no way an honest government can cover it up. Now, it happens to be Trump. President Trump did a great job, along with Larry Kudlow. They did a great job in trying to set up low taxes and a growth rate, and they're on a trajectory for growth to outpace debt increases. If the United States growth can outdo their increase in debt, ultimately it'll be a balance, and ultimately we'll have a great economy long term. But the Democrats aren't working on that. The Federal Reserve isn't helping with that. And I don't know whether we'll ever have that, but now the rate of debt is growing tremendously. And as taxes go up and as corporations are hindered due to the latent socialism that the Democratic platform is looking at, it'd be very difficult for economic growth to outpace the increase in debts. So this is another long topic. I just want to tell you my view on bonds is negative. And even if we have an inflationary period, you're saying they'll do QE and they'll keep buying the bonds, keep them declining. Maybe that's an experiment they tried. I don't think they can continue doing that again. So there's a lot to be said about bonds that we really can't do in just a couple of minutes that are left.
Yeah, we'll have to do that next time. Milton, it's been an absolute pleasure. Thank you for coming on, sharing your insights. Thank you, everyone, for watching. Again, you can find Milton on Twitter @BergMilton and his website, miltonberg.com. Thanks again.
Thank you so much. Thank you. Enjoy it. Thank you.